For more stock news updates, remember to press the like button and subscribe. With that being said, let's get straight into the video. In its early years as a publicly traded company, Palantir Technologies faced numerous challenges in establishing a prominent position within the enterprise software market. However, everything changed on the 7th of April, 2023, when Palantir's Chief Executive Officer Alex Karp released a groundbreaking letter to investors. This communication proved to be a pivotal moment for the company. In the letter, Karp announced the imminent launch of Palantir's fourth major product suite, known as the Artificial Intelligence Platform. This strategic innovation showcased the company's commitment to advancing artificial intelligence solutions and marked a significant step in redefining its identity in the market. Since the introduction of the Artificial Intelligence Platform, Palantir's stock price has skyrocketed. The timing of this dramatic rise in Palantir's share value is no coincidence, given the current dominance of artificial intelligence within the investment world. Investors globally have shown immense enthusiasm for companies pioneering artificial intelligence technologies, fueling unprecedented interest in this sector. However, it is essential to highlight that Palantir's success is not solely attributable to this broader market trend. The company has demonstrated its ability to hold its ground against some of the largest players in the technology industry, further underscoring the transformative impact of its artificial intelligence platform on its business model. This innovative platform has not only revolutionized how the company operates, but has also positioned Palantir as a serious competitor in the artificial intelligence and enterprise software space. Considering the rapid rise in its share price over the past 2 years, Palantir presents an intriguing candidate for a potential stock split. Let us delve into the reasons why the company may or may not choose to pursue this strategy. A review of recent history reveals that many leading technology companies such as Tesla, Nvidia, Apple, Amazon, Alphabet, and Broadcom have executed stock splits. Each of these companies experienced significant and sustained growth in their stock prices before deciding to implement splits as highlighted in prior analyses. Palantir shares several similarities with these major players. In 2024, the company achieved a remarkable stock price increase of over 300%, making it the best performing stock within the S&P 500 index. As demonstrated by the notable surge in its valuation during the latter part of 2024, Palantir has seen its share price rise to levels that may now feel unattainable for smaller retail investors. This rapid increase in value has prompted discussions about whether a stock split could make the stock more accessible to a broader range of investors. It is important to emphasize that stock splits do not impact a company's overall valuation. Instead, they adjust the share price by dividing the existing shares into smaller units, creating the perception of a more affordable price per share. This psychological effect often attracts a larger pool of investors, driving increased demand and, subsequently, a rise in the stock's price. Furthermore, stock splits increase the total number of shares available on the market, enhancing liquidity and making it easier for investors to buy and sell shares. A stock split could serve as a strategic move for Palantir by making its shares more accessible to a wider audience. In November, Palantir transitioned its stock listing from the New York Stock Exchange to NASDAQ, a decision likely influenced by the company's desire to align itself more closely with the technology sector. NASDAQ is widely recognized as a hub for high-growth technology companies, and this transition signaled Palantir's commitment to positioning itself as a key player in this space. Following this transition, Palantir was added to the NASDAQ 100 index, a milestone that brought the company greater visibility among institutional investors and other market participants. This inclusion further solidified Palantir's reputation as a high-growth opportunity within the technology sector. Now that the company has demonstrated consistent revenue growth and accelerating profitability, it has firmly established itself as a major contender in the industry. However, the company's management may feel less compelled to pursue a stock split purely to enhance trading liquidity, given its already strong position in the market. From a management perspective, stock splits are not without challenges. They require approval from the board of directors and demand significant time and resources to execute. Companies often collaborate with investment banks and accounting firms to conduct detailed modeling and analysis of how a split might impact the business from financial and operational standpoints. These processes can be time-intensive and costly, particularly for a company like Palantir, which is still in a growth phase. Despite its remarkable achievements since the launch of its artificial intelligence platform, Palantir remains focused on expanding its operations and capturing additional market share. In my view, the company's leadership should prioritize scaling the business and pursuing strategic growth opportunities, rather than dedicating time and resources to evaluating a potential stock split. While the idea of a stock split is an intriguing concept, it may ultimately serve as a distraction from Palantir's core mission of driving innovation and growth in the artificial intelligence and enterprise software sectors. In other news, Palantir has experienced a remarkable surge in performance recently. This success can largely be attributed to the company's strong track record of assisting both commercial and government clients in harnessing artificial intelligence to improve operational efficiency and enable real-time decision-making processes. The company's financial results for Q3 of 2024 only strengthened the bullish sentiment surrounding its prospects. Within the United States, a market that accounts for nearly 70% of Palantir's total business, revenue from both commercial and government segments grew by 44% on a year-over-year basis. This significant growth reflects Palantir's ability to deliver high-value solutions tailored to both sectors. Notably, U.S. government contracts continue to represent the largest portion of the company's revenue streams. This reliance on government contracts is unsurprising, given that Palantir was initially established to support critical defense and intelligence operations for the United States government. Despite this impressive momentum in 2024, the start of the new year has presented challenges for Palantir. Broader market volatility, combined with a recent downgrade by Morgan Stanley, which rated the stock as underweight, has led to a decline of nearly 10% in its share price. While the company remains a leader in the artificial intelligence sector, these headwinds suggest that its path forward may be more complicated than its previous trajectory. Adding a new dimension to the discussion is the inauguration of a new president who plans to establish a Department of Government Efficiencies, abbreviated as DOGE. This new department aims to emphasize transparency, cost reductions, and improved efficiency across government operations. Some analysts and investors are speculating that the creation of DOGE could act as a positive force, potentially providing additional growth opportunities for Palantir. However, not everyone shares this optimistic outlook. One prominent investor, who operates under the pseudonym Investor Express, has raised concerns about the potential implications of DOGE for Palantir's business model. According to Investor Express, the department's focus on transparency and cost-effectiveness could become a significant obstacle for the company. Specifically, the investor highlights that Palantir's government contracts may come under increased scrutiny, particularly given the high costs associated with the company's proprietary solutions and its lengthy sales cycles. Investor Express further elaborates that DOGE's preference for open-source technologies could create challenges for Palantir, whose platforms rely on proprietary systems. The investor notes that the department's emphasis on cost efficiency might clash with Palantir's pricing structure, which is often considered premium. This could lead to reduced demand for Palantir solutions within the government sector, particularly as the department prioritizes more cost-effective alternatives. Beyond the concerns related to DOGE, Investor Express also points out structural vulnerabilities in Palantir's business model. A significant portion of the company's revenue comes from just 20 clients. This heavy reliance on a small customer base increases the company's exposure to potential disruptions if any of these clients reduce their spending or terminate their contracts. Additionally, the investor highlights the growing competition Palantir faces from established technology giants such as Microsoft. These competitors are increasingly entering the artificial intelligence and data analytics space, bringing with them significant resources and expertise that could challenge Palantir's market position. The investor also emphasizes the risks associated with Palantir's current valuation. The company is trading at a multiple of 55 times its revenue and 161 times its free cash flow. These elevated valuation metrics suggest that investors are pricing in robust growth for the company in the coming years. However, any slowdown in growth or additional challenges could result in a significant compression of these trading premiums. As a result, the investor has issued a sell rating for the stock. This bearish outlook is echoed by analysts on Wall Street. Out of 17 analysts covering Palantir, only 2 have issued buy ratings, while 8 recommend holding the stock and 7 have assigned sell ratings. The consensus moderate sell rating reflects the broader skepticism about Palantir's ability to sustain its current growth trajectory in the face of mounting challenges. Additionally, analysts have provided a 12-month average price target of $46.57 for Palantir stock. This target implies a potential decline of over 30% from its current levels, underscoring the cautious stance many investors are adopting as they assess the company's future prospects. In conclusion, while Palantir remains a leader in the artificial intelligence space and has demonstrated strong growth in recent quarters, the road ahead is likely to be more difficult. The combination of market volatility, heightened competition, structural vulnerabilities, and potential policy shifts under the Department of Government Efficiencies introduces significant uncertainty for the company. Investors should carefully weigh these factors when considering their position in Palantir. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.